Okay, Assalamualaikum and good day to everyone. So today, we are going to learn about risk and return. So at the end of this chapter, you should be able to understand relationship between risk and return. Okay, you can identify and perform the computation and explain the various type of risk that finance manager and investor face. Okay. Actually, for risk, risk is a concept that denotes a potential negative impact to some characteristic of value that may arise from future event. Okay, actually we exposed to risk in our daily activities. For example, when we cross a road, when we run the risk of being hit by automobile, or when we are in building, we are at risk of building collapsing. So this is a type of risk. So making decision in business also involve risk, where for example in the selection of vendor for equipment, so it is not properly qualified, or in undertaking a capital and expenditure, okay, they can cost overrun, or the capital expenditure may not deliver the desired result. Okay, so for a manager of fund, the main job is to be able to invest money to obtain appropriate rate of return. Okay, so for the rate of return, it can be defined as follow, where annual income plus ending price minus beginning price over beginning price. This is the formula for rate of return. So possible return on investment linked to the risk in the investment itself. So it helps us to make meaningful deduction from data that is available from the stock and also bond market. Okay, this chart show the investor who invest from South Korea, Malaysia, India, Singapore and Indonesia. This is a stock index in various countries. Okay, from December 2003 to December to November 2011. Okay, so it gives the idea about the returns of the risk-free rate, or the rate at which the government of the country borrow for 1 year. Okay, the rate at which the government of the country borrow for 1 year, we call it as a yield of 1 year treasury bill. Okay, between risky and risk-free asset in various countries, here at the figure you can see Nifty from India. Okay, Nifty from India has the highest return, return of stock, which is from which is on the 1st February 2008, where it then fluctuate then increase back until 5,000 here, amount 5,000. Okay, the trend, it fluctuate, it go up and down from this figure. So at least in the equity market, all the assets seem to be moving in tandem. Okay, moving in tandem with each other, or they are highly correlated. You see, highly correlated. Also from the graph, okay, it can be seen that Nifty showed the sharpest peak in December 2007. Okay, December 2007, Nifty showed the highest peak around here lah, December 2007 to 1st February 2008. Okay, However, if an investor invests in Nifty Stock Index in December 2007, okay, December 2007, he or she would have lost most value in a year, okay, from this figure. So this graph also shows the value of treasury bill rates of various countries over time, from Malaysia, Singapore, Indonesia, India and Korea. Okay, this is the comparison of returns, okay, from various countries. So where the return of the investment in the stock index were high, an investment made 2007 would have been at loss in 2009. Okay, from the figure just now. Okay, now you have to understand what is the meaning of different type of risk. Okay, first you have to understand about risk averse. Okay, what is risk averse? Okay, risk averse is a behavior where the tendency of person to reject a bargain with an uncertain payoff and accept another bargain with a more certain but lower expected payoff. Okay, this is the meaning of risk averse. They tend to reject, but they also tend to accept the bargain with more certain but lower expected return. Okay. However, risk-loving behavior of investor is the willingness, okay, to take additional risk for an investment, okay, that has relatively low expected return. Okay, risk-loving behavior is the type of person who love the risk. So they're willing to take additional risk for investment. Okay, risk neutral is people who judge risky investment by their expected rates of return. Just neutral. Okay, and risk neutral people is the person who are not really a risk averse type of person or not really a risk loving type of person. Okay, the neutral saja. Okay, this is a graphical depiction of investor. Okay, for risk averse, they tend to accept the bargain with more certain. Okay, risk loving very love the risk, whereas risk neutral is just neutral. It's either between risk averse and risk loving. Okay, class the measurement of risk. So in the case of risk of investment in share, the risk concern is typically measured by standard deviation. We use standard deviation to measure the risk. Okay. So this is the example. Okay, for example, consider two possible investment. We got investment for share A and B. Okay, and then P is the probability of return on A. Okay, R is the expected return on A. PB is probability return on B, and RB is expected return on B. Okay, so how you calculate using the standard deviation? You use the formula of mean return or expected return. Okay, this formula. In standard deviation, this formula. Okay. So using this formula, you just take the probability times the expected return for mean return of share A. Then you get 19.5%. Then for mean return of share B, you take the probability of share B times the expected return of share B. You will get 20.65%. And then for the standard deviation, for share A, okay, previously you take the 0.05 is the probability, you times the return for share A, okay, -10, okay, you minus the mean return, okay, 19.5%, okay, to the power of 2. Okay, and then you plus the rest lah. 0.25 is the probability times the expected return times mean return minus mean return. So you get the standard deviation of share A. Okay, same method you should use to calculate the standard deviation for share B. So you compare share A and share B. Which one higher? Share B, right? So because share B has a slightly higher mean return, so it has higher level of risk. So share B will have the higher level of risk compared to share A. Okay, this is the formula for mean return. In order for you to calculate the risk and return using historical data. Okay, and then standard deviation using historical data. Okay, for example, you can see here, you are given 5 years from year 4 until 0, return of share C and then return of share D. Okay, so in order to calculate using the historical data for share C, you add all the return of share. Add all, and then you divide by 5 years. Okay, you get 6.54. And then mean return for share D, same method. Add and divide by 5, you get 8.11%. Then standard deviation, you take the return of share minus the mean return to the power of 2. Okay, you plus all, divide by 5. And then square root. You get 8.37. So same for share D. So you compare from share C and share D, we can see that share D has higher mean return than share C. So it also has a higher standard deviation of returns, where indicate that which one has higher risk? Share D. Okay, share D has higher risk. Okay, so how you manage the risk? Okay, some of the risks faced by any business are regulatory and policy risks. Okay, which we cannot easily change. Okay, it is it can be changed or modified as per the wishes of the regulator or government only. And then sales risk means the possibility of low sale is known as sales risk. Okay, we have sales risk if we got the only low sales. And then project risk. Okay, project risk is come from various type of project. So there the risks that may occur include if we cannot complete the risk within the deadline. Okay, this is the risk concerning the finance manager, which is cash flow risk, any capital structure risk, default risk, and reinvestment risk. Okay, cash flow risk means you get many demand in product, but payment is only in credit, so there is no cash inflow. Then for capital structure risk means that the various instruments available are loan, bond, which are example of debt. However, these instruments have feature of both debt and equity. So the consequence that the servicing of the financing is heavy burden to the organization. Okay, default risk means investor in a fixed income security which promises a stream of cash flow is always subject to the fact that security might not pay the cash as promised. Okay, and then reinvestment risk means where you target the rate of return of X% over a period of 10 years. But it may be possible to invest all the money in a single security in over 10 years. So we need to invest in some that have maturity of less than 10 years. So in this case, okay, the amount that mature after 5 years need to be reinvest because you have to follow the project. Okay, that's all for today. about risk and rate on return. Thank you.